Hello and welcome to this week's episode of the Long Only Podcast. I'm Doug.
I'm Jerry.
Jerry, how are you doing today?
I'm well, Doug. How are you?
I'm all right. It's not bad. So, any updates in the personal life you need to tell the audience about?
No,
All right.
living life.
Living life, swimming along?
Nothing new. No
Nothing.
new grandbabies yet.
Not yet, but we're getting there.
Couple months,
A little bit longer.
a little longer.
We haven't lost any chickens recently, so I don't think I've given a chicken update in a while.
Well, the last was it the bobcats that were getting your chickens?
We think so.
Yeah.
We got 4 new chickens from some friends, and so now we have 8 again.
Are you getting lots of eggs?
We are getting a fair amount of eggs. The 4 adolescents just started laying, so we're getting a lot.
You have extras?
I don't know, for people I like, maybe. So
Well, let me know when you have extras. I'll buy them from you.
I don't think you need to buy. So
You'll give them to me.
yeah,
Okay.
we could probably make that happen. Well, let's get started today with a topic that is near and dear to our hearts. Well, it's really near and dear to everyone's heart, everyone who lives someplace. Let's talk about real estate for a moment. And the obviously we're not real estate investors. Jerry and I have each bought some real estate, so this isn't our first rodeo with regard to that. But Jerry had an idea for the show, and what do we do in response to the latest Fed announcement that they did the normal tea leaves and everything, and the dancing before the sun and sacrificing a chicken, and we still haven't. Then we look at the entrails, and then we figure out whether what the Fed is going to do. I just have to say, as a point of personal opinion, I would just like it if the Fed would just meet and then tell us what they decided, and then that's it.
And then shut up.
Shut up, because they're literally turning this into a game because they don't want to tip their hand one way, but they also want to give us information. It just seems like why are they trying to this strategic ambiguity? I understand why they're not telling us what they are going to do, but if they're not going to tell us what they're going to do, why tell us anything?
Well, they do kind of tell us what they're going to do, in that they have this dot plot which comes out from the Fed that shows what the Fed governors are saying, where they see rates over the course of what X period of time. So they do telegraph, but we've said this a lot of times, and I'll say it again. I'm just flabbergasted at the level of attention, like insane level of attention that the Fed gets. I mean, yesterday or Wednesday? I guess
This was a record on a Friday, Groundhog Day.
Recording on a Friday. Whatever. It was Wednesday, I guess. I don't know, but whenever they met in the last couple of days, the focus from media, particularly, it's on, you see the Fed decision countdown on the financial news networks, and then there's the hanging on every word that's in the Fed statement, and then every word that the chairman Powell says in the post news conference. I mean, the Federal Reserve is not what grows the economy. I mean, they can really mess things up, and they often do, and they have for the most part.
How dare you?
What's that?
How dare you?
Yes. Well, so it's gotten nauseating, the extent to which they are the focus. Which probably, so yes, I mean, it does seem clear that rates are coming down. The question is when, and at the end of the day, does it really matter if it's 3 months from now or 6 months from now? No. But the markets, are so much more. I mean, I would always say there's been, or in my career anyway, it's been too much focus on it. But it seems like it's gotten more so. And markets get so volatile around these Fed comments that it's really quite crazy.
All right, and then with that lengthy intro,
anyway, go ahead.
Let's get to the meat of what we're talking about.
Yes.
Our opinion: should you buy now if you need to buy, or should you try to hold off till some interest rate cuts if you have a real estate need? So real estate, what to do if you find yourself in need of, say, a home. We all need a place to live. So
Yeah,
Jerry,
conventional wisdom is that, people don't want to, buy homes right now. And this, let's focus on the first-time home buyer as we try and we're trying with this podcast to, help younger people make, good financial decisions. So first, should the first-time home buyer wait until interest rates come down because then housing will be more affordable? I think the answer to that is no, because what we're seeing in most markets, not all, but most markets, is that the real estate market has cooled considerably because of the higher interest rates. And unlike, a couple of years ago where bidding wars, especially in places like where we live in the Phoenix, Scottsdale area, where you go to try and put an offer in on a house and there's 55 other offers on the first day that it hits the market. It was insane. That's not happening right now. And so you're much more likely to get a decent price. And, because you can, refinancing is relatively possible these days and has been for a while. If you're borrowing to buy a home, obviously it limits how much home you can buy by virtue of, higher interest rates mean it's harder to qualify. Therefore you need more income to be able to qualify when rates are higher. So that affordability aspect of housing is low. But if you somehow can act and could get away with getting a mortgage and qualifying and all that, I think you're better off buying while the market isn't in a frenzy and you may be able to get a better deal than waiting for interest rates to come down, and then we're back to this craziness, and you might have to pay through the nose or pay up significantly to just get in. All of this, the caveat on all of this being that make sure you're buying in a place where is in front of the path of growth, and certainly this Phoenix market is, and there places like Texas and Tennessee and Oklahoma and Florida and Georgia, and there are places South Carolina, North Carolina. And others, Idaho, that are definitely in the path of growth, as evidenced by what it costs to buy a one-way U-Haul from states that I didn't mention to states that I do mention. It's very expensive, like significantly more expensive than going the other way. So that should tell you something about where the path of growth is, and I expect that will continue.
Look where the people from Illinois, New York, and California are going.
Yeah.
So, and try to buy before they've ruined it.
That's not to say that, and I would say, being contrarian, there could be an argument back. Well, it's been that way now for some time, and we're due for a correction on that, and those places could start getting policy right again, and then that changes things. And I would agree that's true. But I'm afraid that we're so far away in those places from policies changing to where businesses are more attracted to stay in the places that are right now losing population, that it doesn't appear that there's going to be anytime soon we're going to see that correction back the other. Maybe you'll have a correction, but any kind of significant change in trend that results in a reversal of that, I don't see that. I don't see that's in the cards anytime soon.
And I would say that we're talking about those who can't afford to do so. I'm going to give some very controversial financial advice, and I'm going to say, if you can't afford to do something, don't do it. So if you can't afford to buy a house, this isn't a conversation that we're really having, but generally speaking, when you look at real estate, the best time to purchase real estate is when you can afford it. And so trying to time the market, much like stocks, can be a bit of a fool's errand. And there's a good quote last episode of The Office where Andy Bernard says, "I wish there were a way to know when you're in the good old days before you've actually left them." And I think that a lot of people who are in the real estate investing, and again, we're not talking about what investors should do, but there is something you can learn. The people who are in real estate investing are looking at this as a buying opportunity because the market is quieted. You've got low inventory, true, but you've also got low competition. you don't have to deal with that added stress that you mentioned of having a bunch of offers on a house. I think you're going to see people eventually find that they're going to, on paper, be in better position to afford a good down payment, and on paper able to afford a better home, but they're going to immediately get arbitraged out of that home once the interest rates start going up. And also, last year in March, and again, I'm borrowing off of people smarter than me when it comes to real estate, but last year in March, the normal seasonality we saw largely got paused in the real estate market. People got panicked because the rates were up so high, and they put off decisions. Spring is generally the busy time for real estate, and I think that a lot of people who punted for a year are going to find that marriages happen, people have kids, people need bigger homes, life goes on, and they're going to realize that these interest rates are still relatively low by historical standards, and if they can afford to act, I think it would be wise to do so. And I think we're going to see a lot of people do that, irrespective of I didn't say irregardless, but irrespective of what the Fed does. So
yeah, I mean, these interest rates are not that far out of the norm from a long-term historical standpoint. I remember the first house we ever bought was at a much higher interest rate than it is today. So we just got so conditioned to these, Fed's 0% interest rate policy that led to, 3%, 30-year mortgages, which is just insane. But we're probably going to, work our way back down. So, if mortgage rates today are, a bit below 7, I think we're at right now on the 30-year mortgage.
I guess 7.5. I just looked, something like that.
7.5?
Yeah.
I thought it was a bit below 7. So, okay. Well, in any event, I think it probably finds its way back into the 5s. 5, maybe 6%. And of course, it's going to vary depending on credit worthiness and, size and what have you. But it wouldn't surprise me if by this time next year, we're back in the 5s. And depending on how slow the economy is, which kind of probably leads into our second segment. And you might be asking why, but I'll answer why once we get to the second. As far as future is concerned and where interest rates and where the economy is going.
I think generally speaking, our advice is going to be pretty consistent. When you have money to invest, do it. And if you're waiting to time, and real estate is an investment, it's also an emotional utilitarian decision, but it's an investment as well. And when you can afford to do it, you should do it, because trust me, we're not that smart. So if you're waiting to get in, everyone else is too. And I think you're just going to trade one set of problems for another if you wait. So, and I think my good friend Jerry agrees. Again, this is all assuming.
Speaking. Yeah. The only thing I might take exception to is, yes, by default, I think real estate or your home has become an investment, but I don't think it should be. It should be a consumption item, and we can discuss and debate why it is that it's become more of an investment, and I think it has almost everything to do with the tax code. Which is part of the reason why values are up as much as they are. But in the time price theory of economics, which we've talked about, where people's incomes have done much better than the price of things, even housing, as ridiculously inflated as it has been, has generally incomes have generally kept up if you look at it from a time price theory standpoint. So how long does it take for somebody to work to earn the money to pay the mortgage? And that number has been coming down. Not as much as in broader commodities, but it has come down, or at least stabilized. It stayed stable. And we've talked about that before, but my point is that it really shouldn't be an investment, because it's not something it shouldn't be something that can have the ability to pay you something. You pay to be in it. So I think there's this kind of balancing act, even still, given inflation in housing over years, decades even, more so decades, that there's a balance between it's an investment and it's a consumption item. But again, we can debate that for a long time.
Noted. And we're going to move on to the next segment. We've only got 2 segments this week, 2 topics we're going to talk about. are small cap stocks at an inflection point? Jerry, are they?
I think so. And I would, let's not even use the term small cap, because a lot of people, that we're speaking our language. That means small capitalization. What's capitalization? It's the value of a company in the market, what the market values it at based on the number of shares times the price of the stock per share. So in public stock trading jargon, we call it a smaller company. And nowadays, with the values of companies having grown over the decades, what used to be a small cap stock is now a much bigger number. So I still like to kind of use the $1 billion market value as below that is small cap, above that is mid cap, and you get above 10 billion, it's large cap. I'm dating myself because there are those that say, well, you're small cap if you're under 5 billion, and you're mid cap if you're 5 to 20 billion, and it's 20 billion and up that are large cap, and then you have mega caps that are like the Apples and Amazons that are in the trillions. So there's certainly some talk about inflation and market capitalizations, but so let's say smaller companies, okay, that have not really, I still don't know that enough people realize or know that the market movement, market meaning market averages, move over the last couple of years has been primarily driven by about 10 companies. If you look at the Standard & Poor's 500 stock index, or the Magnificent Seven, but let's say 10-ish companies make up a significant portion of the return of the market. So it hasn't been very broad-based. Now, recently, it's been broadening out. But in a period of time where some of those mega caps did well, many smaller companies did really poorly, and particularly those that are focused on growing and innovating. I think there is an inflection, partly driven by, in the short run, interest rates finally peaking and inflation finally peaking. Which shouldn't necessarily be the focus, but it is. So in the short run, that does matter. And since those peaked, the short run looks like it's going to, be favorable for smaller companies. But the large. So yes, I think that's causing an inflection. But there may be something more at work here, and that may be after a pretty extended period of time. And I would say most of the 21st century, there has been, it has been an environment that has been less than favorable for smaller companies. And that's primarily because the number one reason, in my opinion, and there are others that would agree with me, I think, plenty that might disagree or do disagree, but the number one reason is the level of government spending has been off the charts and has distorted capital formation and even further exacerbated by bring back the Federal Reserve again, inordinately low interest rate policy for most of the 21st century until recently. And the combination of those two things, and then adding the other very significant component, which has been significant government overreach with respect to regulation. Going back to the dot-com era, late 90s dot-com era, reaction to 9/11, reaction to the 08-09 mortgage crisis. We've been in this kind of perpetual crisis, jumping from one crisis to the other, and the solution has always come from government, more regulation, more control, and all of that has combined to make it a much more difficult operating environment and capital raising environment for smaller companies. Remarkable that many of them still have been able to do well in that period of time, but not as well as they should have, and there should be more of them. Bring back again the 8,000 to 4,000 problem. And I think that's the inflection that might be changing. We might be starting to sense that trend of big government, remember as Ronald Reagan, I believe, said, the era of big government is over. Or maybe it was Bill Clinton. Did Bill Clinton say that, or did Ronald Reagan say that? Ronald Reagan.
Whoever said it was wrong. But
yeah, I think Clinton might have said that actually. as he was, being the moderate play, taking the moderate play post George Bush 1. Nonetheless, you're right. That proved at least it proved short-lived. Remember the peace dividend? You're not too young to remember that, I don't think. I think there could be an interruption, at least an interruption in the trend towards bigger, more intrusive government, more spending government, more aggressive and loose Fed policy. And if that should be the case, then there's really kind of a hang on to the hats, bar the door. We could see a significant kind of like early 80s to late 90s type of explosion, which turned out to be an interruption in the trend, right? We thought it was a new way of doing things and would last, and to some extent it has. I don't think we can discount take the marginal tax rate at one point, which we all know nobody paid, but at one point got up to like 90%, and then ended up at the highest rate being 28% in the Reagan years. What are we at now, right? 39%, I think, is the highest, and most people aren't in that probably either. So, we're still relatively low. So that revolution did not completely go away, but certainly the spending post World War II, and I suppose you could say, post Depression spending craziness, has certainly continued. So that could there be a change? Could there be another change in trend coming? I think there could be, because I think people are starting to get a sense that this hasn't worked that well, and especially for smaller business. Smaller businesses don't benefit. Big businesses do when there's more government control, because they have the money to be able to comply with the regulations. They have the lobbyists. They have all those things that, they love it. And I want to catch myself sometimes when I'm making these accusations and criticisms of the large companies. It's not that I'm against large companies. More power to them, especially, but most importantly, I want them to become large companies in an environment where smaller companies can compete just as easily. But if you're big enough and powerful enough in the marketplace, not how you work in Washington or Brussels or wherever, that shouldn't be what makes you successful and makes you larger in the market.
When competition leads to anti-competition, that's the problem. So
theoretically. Well, that's what's happened.
That's what's happened. Competition is great, and then when companies that rise to the top on the basis of their own merits, suddenly squash competition through cronyism and lobbying, then that's a problem.
Yeah, well, and I would argue that if they get to that point and they're completely on their own with no government support, they're going to get, almost by definition, they're going to see innovation come from below, and unless they're really, really, really good, and there are some companies over the years that have been good at that, over decades, have been good at that, and don't necessarily point to government help to do it. But more and more today, that's what's happening, and that's the problem. I would argue that the antitrust. So, for example, remember the big antitrust suit against Microsoft. When that finally was solved, Microsoft on its own, by virtue of its power in the marketplace, was already starting to lose that luster, and was getting enough competition, from other operating systems, not the least of which is the Apple operating system. And so by the time the government got around to attacking them for being antitrust, or for being a monopoly, they were already waning on that. And so I think that when allowed to operate normally, without, with a level playing field, if you will, it's tough for anybody to stay on top in a truly free enterprise system. If they do, more power to them, and they should be allowed to do so. And I don't mind investing in those companies. But I think we have now an environment where these larger companies have a real advantage that if that should change, then that's going to benefit smaller companies a lot. And smaller companies still generally are the ones that innovate even in spite. Get back to that, we get by in spite. But it should be more pervasive. Larger companies have to be a lot more worried about competition coming from below, disruption coming from below. And right now they don't have to worry a whole lot. And unfortunately, I mean, as investors, it's a bittersweet end game when your company as a smaller company is acquired by a larger company. More and more that's just, companies acquire these smaller companies just to get rid of the problem. There was a time where that was less possible. It could still happen. And if it does, again, in a level playing field in a free enterprise system, if that happens, so be it. If synergies can be reached and it allows that company to then compete even more, so be it. But that there's not enough. What we're seeing now is it's happening because the smaller companies don't tend to have a whole lot of choices.
It does beat the alternative where they're just being litigated out of existence. I mean, acquired is better than that, but yeah, it's not.
So anyway, yeah, I think there is an inflection happening. It may be slow in ultimately culminating, but we'll see. I think a policy correction is coming, and it may be sustainable for a while because I think most folks are starting to look at this kind of this policy environment, not the least of which the cultural environment, but let's just stick to policy. And it really is problematic. It's problematic. When you look at the British Labour Party, when was the last time you could say that the British Labour Party was right of the American Democratic Party? When the British Labour Party is talking about being more pro business and keeping tax rates level or even lower, that there's something going on out there, at least in the broader world. Might Europe finally have figured out that their massive spending social state is not working after decades of underperformance versus the US? Unfortunately, the US trying to adopt more of what they had been doing, it's now tilted to the other direction, and hopefully we won't have to go through a long time of drought in economic growth, like Europe has, to recognize the error of those ways. They seem to be recognizing it.
It's a real world case of the Harlem Globetrotters stealing the Washington Generals playbook and trying to run it. So, yeah. It's also worth noting we don't rely on reversion to mean, but the S&P is at all-time highs. If my math is correct, it's really not math. It's looking at a chart. The small cap indices are not. So something that isn't going to be at front and center of your investing decisions, but lurking in the background is simply the fact that the S&P has more room to run for a variety of reasons.
And just to wrap this up, there is a downside right now, and unfortunately, and I think it's due to the massive amount of algorithmic trading that's going on out there. The majority of trades happen from a computer, not a human. The volatility in these smaller names is off the charts. So you really have to be more than ever able to look the other way, be in it for the business, not the stock trading. Because if you're in it for the stock trading, it's frankly just silly. It's absolutely silly and insane the way some of these changes in prices happen. Which, another podcast, we've talked about it before in previous podcasts, another podcast we could spend on just purely the liquidity issues in the market. I mean, all of these, innovations, quote unquote, financial innovations that have swamped the market that were supposed to give us more liquidity have done absolutely the opposite. And if somebody wants to argue with me on that, fine, make the argument. 38 years of watching stock trading. Do not try and convince me that we have a more liquid market today than we did in the past. it at least is not more liquid. Because these wild swings wouldn't be happening as frequently as they do, literally second by second. And I don't think that's healthy. We can look through it because in our strategy, we're looking for long-term company performance. But it's just annoying and frustrating to have to watch this happen on a day-to-day basis and literally second-to-second basis. That's a downside. Successful investors will be able to look past that. Because at the end of the day, the business's fundamentals will ultimately win out one way or another.
And that'll close the book on this week's episode. Remember, view our firm at taylorfrigon.com, also taylorfrigon.invest on Instagram, and email us longonly@taylorfrigon.com, and like, subscribe, smash the bell, whatever it is people do on YouTube, do it. Until next week, I'm Doug.
I'm Jerry.
And thanks for joining us on the Long Only Podcast.